I'm Chris Fitzsimon with NC Policy Watch, and we're thrilled to have you all here. The long downturn, why it persists, we're not talking about Governor McCrory's approval rating. That's the next luncheon. But we're thrilled to have Dean Baker with us. Rob will give him an introduction, a formal introduction in a moment. I want to just thank you again for coming. It's a crucial time, as you know, in North Carolina, and we couldn't think of a better person to tell us about what's happening to the national economy than Dean Baker. And we want to thank you for coming, and I'll turn it over to Rob, who will do our introduction.
Thanks, Chris. I'm Rob Schofield with NC Policy Watch. Thank you all very much for coming. A couple of little bookkeeping or housekeeping announcements. One is, I want you all please to take note of the Defenders of Justice Awards Dinner announcements on all of your tables. And we have a great slate of recipients this year that the Justice Center is recognizing next month. It's always a great event. It's a big event. It's an evening, a dinner that you don't want to miss. It's where the progressive community in North Carolina comes together to honor some really wonderful people. So please, we very much welcome your involvement. We welcome your sponsorship. If you have an organization that would like to sponsor a table, I'm sure Bill Wilson, where's Bill Wilson? Somewhere. Oh, there he is. My deputy director of the North Carolina Justice Center would be delighted to talk to you about that. So please see Bill after the event. So thank you for coming today to this luncheon. We're glad to have such a full house. We have a few extra seats over here if you're still looking for space. We're co-sponsoring this event today with the North Carolina Budget and Tax Center, which is another project of the Justice Center. And Alexandra Sirota, who's the director of the BTC, will be speaking in just a minute, for just a moment, sort of give you a little warm-up act. I want to acknowledge the longtime director of the Budget and Tax Center, Elaine Mejia, our good friend, is there in the back of the room. She was helping with a training this morning, and we're delighted to have Elaine back. She's one of the people responsible for building it into such a successful project in this state. So thanks to her for being here as well. Dean being here is really a return engagement. I think we had you here in 2010, I want to say, Dean.
Somewhere around there.
The news hasn't gotten a whole lot better, but there's a lot of water under the bridge since that time, and we're just thrilled to have him. I want to read you a little bit about why we've invited Dean to be with us today. He is the co-director, as I'm sure you all know, of the Center for Economic and Policy Research in Washington. He's frequently cited in economics reporting in major media outlets, including the New York Times, the Post, CNN, CNBC, all the big media outlets. He's on, he's ubiquitous in the public policy world these days. He's one of the most visible, progressive public economists in our nation. It's a thrill to have him. He's written several books, his latest being Getting Back to Full Employment, A Better Bargain for Working People. Is that right? That's the most recent one? Yeah. His other books include The End of Loser Liberalism, Making Markets Progressive, Taking Economics Seriously, in which Baker thinks through what we might gain if we took the ideological blinders off of basic economic principles. And False Prophets, Recovering from the Bubble Economy, a work about what caused and how to fix the economic crisis. He previously worked as a senior economist at the Economic Policy Institute and as an assistant professor at Bucknell University. He's also worked as a consultant for the World Bank, the Joint Economic Committee of the U.S. Congress, and the OECD Trade Union Advisory Council. He was the author of a weekly online commentary on economic reporting, the Economic Reporting Review, in 1996 to 2006. He was, in short, one of the most knowledgeable people in the country, and it's a thrill to have him. So, Dean, thanks for coming. First, Alexandra Sirota, who is our incredible director of the North Carolina Budget and Tax Center, going to share just a few remarks, and then we'll get on with Dean.
Yes, welcome everyone. I just wanted a chance to welcome you as well. We at the Budget and Tax Center are very excited about having Dean down here. I think not just to talk about the national economy, but a little bit about what the national economy means for North Carolina and a little bit about what's happening in North Carolina. For those of you who don't know the work of the Budget and Tax Center, we produce research and analysis to inform public policy and public policy that supports a stronger economy for our state. Some of that research is out there, so I encourage you to grab it on your way out, sign up for our listserv, and use that research as you're talking about the economy. I want to share 4 fast facts about the North Carolina economy that I think are really important in this moment, as we hear a lot of claims that really aren't based in reality. And a lot of this was drawn from my colleagues' research who are in the room, Tazra Mitchell, Alan Fryer, Amber Moody-Dyer and Cedric Johnson, who are on the Budget and Tax Center team. So those 4 facts. One, we've heard a lot about the Carolina comeback, that North Carolina's job growth has been unprecedented as a result of the policy choices that have been made. There is no evidence to support that claim. In fact, our falling unemployment rate is almost entirely driven by a labor force decline. Our labor force has declined significantly over the past year. Of those who have left the ranks of the unemployment, 6 have actually just left the workforce altogether. Only 4 have moved to employment. Our job creation rates over the past year are on par with the nation. Nothing special on the job creation front is happening as a result of the policy choices that were made. A second point about policy choices is that we do know what the choices that have been made are creating in our economies and in our communities, and that's a lot of harm for working families who are struggling. We know the unemployment insurance changes have, among many other things, reduced the average benefit amount paid to those who are jobless, who can't find a job in an economy that doesn't have enough for those who want to work. It's reduced their monthly payments by almost $220 a month. To put that in perspective, that's a family of 4's grocery budget. So, you can imagine what that means when you're trying to make choices about where to spend your scarce resources. Another thing is the tax cuts. We know, while those just went into effect in January, we do know they're already had an impact in terms of our state's ability to make investments. We won't have $525 million over the next 2 years to invest in our public schools, in our infrastructure, in our public health system, because those dollars were spent on tax cuts that primarily benefit the wealthy and profitable corporations. And Cedric's done some work to really lay out what those dollars could have been used to do, and many of those investments we know are what build a strong foundation for the economy. So 2 other facts. The third fact, the long-term trend in North Carolina is really troubling. So we know from recent research that we put out that income inequality in this state, as in the nation, is growing. It is a barrier to opportunity for so many North Carolinians because there is just this challenge of moving up, earning wages, and being able to provide for their family. Income has grown over the past century by more than half of the income growth over the past century has accrued to the top 1%. Bottom 99% have seen what's left over, and that's just not a policy, again, a trend that we want to see happening, and we know there are policies such as unions and other tools at our disposal to really improve the issue of income inequality. The final point, a more recent trend in North Carolina, is just the boom in poverty wages. So we talk a lot about we need more jobs, but we also need more good-paying jobs. And in North Carolina, over the past decade, we've really seen an explosion in poverty-level jobs and job growth. That's been where most of the job growth has occurred, and obviously that has implications for how families are able to provide for their families, how families participate in their local economies and communities. So those are 4 facts from our research. If you're intrigued, I encourage you to sign up for our listserv and get some more research out front. And again, thank you so much for coming, and I'm very excited that Steve's here to share his insights.
Thanks, Alexander. I should have noted also, we have a large audience that will be watching this event online. If you have friends who couldn't be here today to join us, tell them this will be appearing on the Policy Watch website probably tomorrow. Ricky Lung, our great director of what do we call you now? New media director. We'll have that up on the website. Czar, exactly. We'll have that up on the website. So tell them to check that out. So without further ado, please join me in welcoming Dean Baker.
Well, thanks, Rob and Alexandra, and thanks for having me down here. It's good to have a friendly audience, although I'm used to hostile audiences. It's actually, hearing the accounts in North Carolina, I often like to go to states where I can say, oh, you're saying great things, and, less great things here. You know, the story about the unemployment, the cuts of benefits, and people leaving the labor force, it should be well known. I don't know how well known that is, but this is something we actually got a little involved with back at CPR, my center. There was a paper that some Norwegian economist did. I didn't know him at all, but I don't really know anything about him. But he did this paper that purported to show, you know, look, this has been a great success. You know, you cut benefits, and all these people found work. And it got written up in the Washington Post, a few other places. We're going, oh, what is this? Because, you know, there has been research on this topic, and overwhelmingly finds, not just here, that when people's benefits end, you know, the story conservatives like to tell us, oh, they realize they got to go get a job. Well, a lot of people have done research across the political spectrum, and it's pretty much all found the same thing, that they give up looking for work. You know, you've been looking for work for, you know, 2 years, you haven't found anything. They cut your benefits. I mean, one thing about unemployment benefits, to get the benefits, you have to keep looking. So, you know, you are looking. Maybe not looking that hard, but you're looking. You have to do that. That's to get conditioning your benefits. So your benefits end, you stop looking. Well, anyhow, so he did this study and said, no, well, that's really not true. They all found jobs. And we're sort of scratching our heads because, you know, we know the published data. You know, we have data on payroll employment. Nothing's going on in North Carolina. It's not going on in neighboring states or the country. You know, faster, maybe a little slower, but it's not faster, surely. And, you know, they have the household survey, and that doesn't show that in the published data. He claims to have analyzed the data, you know, which you could do. We do that. You know, you get the micro data, and you can analyze that. And, you know, he claimed to show that there's this big jump in growth. So we're kind of scratching our heads because it's really at odds. You know, we could contact him and say, well, what did you do exactly, and go over his computer programs. We just looked. This whole thing, it's a short paper. It's basically one table. And he was good enough. He's got 12 months of data. He starts in November of, you know, 2012. And he runs through, I think it was November 2013 at that point. Well, he does in his data show this big jump in employment from July, I think, when the cuts went into effect, through November. So, wow, you know, interesting. Well, but he also, you look at it, go, he also has a big plunge in employment from November of 2012 till February of 2013. We looked at that. He had employment in North Carolina falling by 7% over those 3 months. To put that in perspective, that's 4 times the rate of job loss that we saw post-Lehman. You remember when we were losing 800,000 jobs a month? He said North Carolina was losing jobs at 4 times that rate. So I did a little blog post saying that, you know, after your governor got elected, you know, you saw the biggest fall off in employment since Sherman's army came through. Someone from your governor's office contacted me and said, I don't think that's true. I said, I don't think it's true either. That's what this guy's data shows. Anyhow, I think we made sure that paper didn't get very far. So anyhow. So my talk today, I'm going to be talking about the downturn and why it's persisted. This has had some people perplexed, and what I'm going to say is I don't think there's really much reason to be perplexed. Basically, and I'll just give you the punchline, basically, to my view, the story is very simple, that the economy prior to the crash in 2008 was being driven by a housing bubble. Basically, the story here is the housing bubble created demand both directly, because construction was at record levels as a share of GDP, so it directly created demand that way, and indirectly through consumption. People had all this wealth. People bought a home for $150,000. Now it's $300,000. They were spending based on that wealth. That wealth disappears. So those sources of demand go away. Instead of construction being very high, construction falls a lot, very low, and consumption, instead of being very high, it falls back to more normal levels. And the problem the economy faces now is there's nothing to replace that demand. So rather than a lot of people being perplexed, like, well, what's the slump? Why is this? It's like, why would you expect otherwise? What will replace the demand? So that's basically the story I'm going to give you, that we're having a prolonged slump, which unfortunately I don't see anything on the horizon that's really going to change that. So wish I could be more optimistic. I mean, I'll say a few things about how things could improve, but you know, I have to say realistically, certainly the politics in Washington, I don't see anything much very good on the horizon. Okay, first, just basic chart, make a couple points here. This is the unemployment rate going back to the late 40s. A couple points I want to make. First off, the unemployment rate obviously has come down most of the way. We're at 4.5 before the downturn. We've come back most of the way. We're up at 10% at the peak. That looks pretty good in the sense that we've gone most of the way back. We're at 6.5 or 6.7. So we're down, we made up more than half the rise. If you looked at the employment, I'll come back to that in a second, it doesn't look nearly as good. So what's happened is we've had the same thing in North Carolina and many places around the country. People are dropping out of the labor market. Okay, so not a good story in that respect. So we're better off certainly than we were in 2010 at the trough of the downturn, but we still have a long way to go. A couple other points I just want to make. I wrote the book with Jared on benefits of full employment. We did get below 4% unemployment. Now this may not be that big a factor today, although it might be given some of the debate we've seen. One of the arguments that we will be having is how low can the unemployment rate go? And what we're seeing already is a lot of people are saying, well, you know, we're just going to have to get used to a higher unemployment rate. Implicitly, what that's saying is, okay, we should start to get the Fed put the foot on the brakes, slow the economy, don't let the unemployment rate fall further. Well, Jared and I wrote our book on benefits of full employment. We were very much focused on, you know, the late 90s. We got the unemployment rate way lower than anyone thought possible at the time. You know, economists like to rewrite history to bury their own mistakes. Back in the early and mid-90s, it was absolutely conventional wisdom. The unemployment rate could get below 6% without causing the inflation rate to start to accelerate. And this is across the political spectrum, so it wasn't just, you know, the right-wing Republicans who were saying that. Alan Blind, who was a good economist, I like him, a decent person. He was on the Federal Reserve Board. He said that. He was arguing with me. I remember having an argument. In fact, Janet Yellen, who was also on the Fed at the time, she was arguing with me. They're both, you know, like, oh, come on, you know, you can't, you know, we have a lot of evidence. You can't think the unemployment rate can get below 6% without causing inflation. We were very fortunate. We had a very eclectic economist as chair of the Fed, Alan Greenspan, who I derided at great length for not doing anything about the housing bubble. He deserves our criticism. But the one really great thing he did, he's not an orthodox economist. He took a look at the economy back in the mid-90s when the unemployment rate was, you know, getting below 6%. And he was being told literally by Janet Yellen, Lawrence Myers, and other appointees to the Federal Reserve Board, they were saying you have to raise rates, we're going to have inflation. Greenspan said, I don't see any inflation. Why shouldn't we let the economy keep growing? Why shouldn't we let the unemployment rate keep falling? And that's what happened. Greenspan at that point already had a lot of stature. He carried his weight. And we got the unemployment rate down to 4% as a year-round average in 2000. Now the great thing about that was not just that meant millions of more people had jobs. This was the only time since the early 70s when you saw wage gains up and down the income ladder. The takeaway, you know, and this is really much of what Jared and I write about in the book, the takeaway from that is that the unemployment rate, having a low unemployment rate, is not important just for those people who get jobs, but it's important for people already working because it gives them the bargaining power they need to be able to push up their wages. So what you saw in the late 90s was that workers at the bottom end of the income distribution, people at the 10th percentile, 20th percentile, 30th percentile, they were getting wages that were in step with productivity growth. So that was what you want to see. And you know, there are a lot of other things I could go on at length. I'll stop myself in a second. But you're seeing things, you know, there were reports of employers in suburbs that couldn't get enough workers. So they were arranging to have private buses go into inner cities, and they would pick people up at corners and take them out to, and this is to work in hotels, restaurants, not terribly high-paying jobs, but the point was they couldn't get anyone otherwise. And in more normal times, or times of higher unemployment, they would never do that. They wouldn't have to. Okay, so it's very important to get the unemployment rate down as low as we possibly can. And when these people are telling us, well, 6.5, that might be as good as we could do, and we have some people saying that. It's really important we argue with them and we say, no, we can do much better. And I'll just say, the evidence that people had that 6% was as good as we could do in the mid-90s was a hell of a lot better than the evidence that anyone might bring to bear today, that 6.5 or 6 or 5.5, you know, that's the best we can do. They actually had decent evidence. I thought they were wrong, and they were wrong, but they actually had some decent evidence. They don't have any evidence worth anything today. So very important we get down to lower rates of unemployment. Just one flashback. Good old days. We were below 4% unemployment for a lot in the late 60s. So different era, I know. Okay, just how we're doing cross-country-wise, just to make a couple points here. The United States here is the second to the bottom here. This is employment population ratios. This is prime age workers. I don't think I say this on the chart anywhere. This is 20 people who are 25 to 55. And you know, the idea is that these are, for the most part, people want to be in the workforce. I realize some people might be out for a period of time and caring for kids, family members, or whatever. But these are, for the most part, people who want to be in the workforce, not early retirees, not students. The United States looks not particularly good in this story. The big gainer here is, of course, Germany. And people often contrast the United States with Germany by saying Germany has this boom, this export boom, this and that. Well, Germany's exports have done pretty well, but the reality is that the U.S. economy has grown pretty much the same rate as the German economy since the downturn. So it's not that Germany, in fact, the U.S. economy in the latest data is a little ahead of Germany's economy since the beginning of the recession. So it's not that Germany's economy has grown more than ours. The reason why they've actually had an increase in employment to population, where we've had a modest decrease, is that they keep people at the workplace. They have policies where they encourage firms, rather than laying people off, they have them work shorter hours. And we do that to some extent, but not really very much. And as a result of that, we've had a much steeper fall off in employment than Germany. I keep pointing to France here, right? Here's the United States. That's one we should be focused on. We've had a fall off in employment where they've actually had an increase in their employment to population ratio. Now, they also have slower growth in population, so that also makes it easier, so that is another factor. But the big thing there is they've been able to shorten hours. So it's not that Germany's had more growth than we have, they haven't. They've managed to keep people at the workplace. Japan is also interesting in this story that they've actually had an increase in employment as well, and a different set of policies. They actually have, at least recently, encouraged growth. And one of the interesting stories there, I don't break this out here, but if you looked at employment rates of men and women separately, Japan, not that we don't have sexist barriers as well, but they historically have been a much more sexist society. I think it's probably fair to say, at least at the workplace, than the US. And they now have a higher employment rate for women than we do, which is kind of a striking story. Okay, here it is by age group. This was the thing I wanted to show. So the point that I was making here, really need my glasses to.
Don't mind?
No. I can see it here. I'd say, I'm getting old and I can't get used to the fact that I really have to put my glasses. I can't. So my point I was going to make here, this again just emphasizing that the big drop is 25 to 54. One of the, to my mind, perverse outcomes in this downturn is that there's been a relatively small drop in employment rates of older workers. Not that I want to see older workers forced out of the workforce, but one of the things you might want to see as you get a downturn and less demand for labor, that you'd have a lot of people making the decision to retire early. Well, that didn't happen. We actually had a big, this is showing employment rates rather than levels, but the baby boomers are, in these years now, 55 to 64. So they're staying in the workforce, working more. Well, some of that's by choice, of course, and they're more educated people than their parents for the most part. So some of that's by choice or good health, that's fine. But some of this was because they didn't have the means to retire early. So a lot of people might have retired if, say, their house price had stayed up where it was back in 2006. Well, they just lost all the equity in their home. Okay, so you had a lot of people that, they might have had 100, 150,000 in equity, and they saw their house price fall by 30, 40%, wiped out their equity. Okay, so you had a lot of people that, were perhaps in a position to retire or near retirement in, 2005, 2006, 2007, when house prices plummeted, they were not in a position to retire. What that meant was, as I said, the employment rates for older workers, 55 to 64, barely changed. If we took the older group, 65 to 74, it actually rose a little, really striking. But that meant that younger workers, prime age workers, and young workers really took a very big hit. Of course, young workers take the biggest hit. Now, again, part of that story is not a bad story. Some of this is people are going back to school, which again isn't necessarily bad, but they're not working. Okay, so getting back to the story, the length of the downturn, the persistence of the downturn. I had a lot of fun with my friends in Washington, other economists, because they're trying to explain a lot of things that don't happen, that didn't happen. that should be hard to do, but you could write a lot of papers on it. There's a lot of people, a lot of very good departments who are explaining things that haven't happened. So one of the things that people are trying to explain is how come people aren't consuming. So you probably have heard a lot of this. One of the, people are pessimistic about the economy, about their job prospects. That's one reason why they're not consuming. Another is debt. There's a whole lot. My friend Paul Krugman has written about this. I tried to say, no, this isn't true, Paul. It's not true. It's not true. But there's a whole literature saying that, well, there's this big debt overhang, and because of that, people aren't consuming. And in my mind, well, look at the data. They actually are consuming. So we have this big effort to explain why people aren't consuming when You know, this is consumption as a share of GDP. We could take consumption as a share of disposable income if you want to take that more direct measure. You'd find a very similar story. People are, in fact, consuming. If I had this as a share of disposable income, we'd see that they aren't quite consuming as large a share as they did back in 2005, 2006, 2007, the peak of the bubble. We'd also find that they were consuming a somewhat larger share of their income at the peak of the stock bubble in 98, 99, 2000. Well, what was going on there was we had bubbles. This is, you know, again, I raised this with economists. I'm amazed at sort of the blank stares I get. These are from economists. I wouldn't be surprised if you gave me blank stares in some boring graduate classes. But these people all sat in the same boring graduate classes. I thought they were the same boring graduate classes I did. Anyhow, one of the things we learned about was the wealth effect on consumption. So sort of a simple story here. You know, if I get, you know, $100 in income in my paycheck, you know, I'll spend a certain percent of that, say 90%. Well, if I have a lot of wealth, if I have a lot of stock, you know, if I have $100,000 in the stock market, if I have $100,000 in equity, well, I'm going to spend based on that wealth also. So I'll spend based on, you know, I got my $100 in my paycheck, spend $90 because of that, but then because I know I have this $100,000 sitting there, I'm going to spend another $5. You know, I'll spend based on that wealth. That very old concept. I mean, I don't even know how far back it goes. I mean, I know it goes back at least to the 30s because there are debates that Keynes was in and they were arguing about the wealth. I won't go into details, but I know it goes at least that far back and probably much older than that. But the idea of people spend based on their wealth doesn't seem like a radical concept. It's been around a long time. I never really knew it was hotly debated. I mean, you try to measure it precisely and some, you know, people go a little higher, a little lower. Well, in 2000, we had stock wealth. People were spending based on that wealth. In 2006, 2007, we had housing wealth. People were spending based on that wealth. That disappeared. We had roughly $8 trillion in housing bubble wealth, you know, my calculations, but I'd say it's a good ballpark number. That disappeared when the housing bubble burst. Now, house prices have recovered some. They haven't gotten back on house prices in a minute. They haven't gotten fully back, adjusted for inflation, to their bubble levels, which is a very good thing. I don't want to see them get back there. But, you know, it's recovered a little bit, but we're still down around $6 trillion in housing equity. So why would we be surprised that people are spending a smaller share of their income, given that they've lost $6 trillion in wealth? So I look at this and I go, consumption's about as good as you could possibly hope for. So the idea that we should expect, you know, people to go out and, you know, start spending more if they're happy, that doesn't make any sense. Now, I don't doubt people are pessimistic. They have good reasons to be. You know, it's a very bad job market. Most people get most of their income from employment. So it wouldn't be surprising to me that people are pessimistic. They have good cause. But the reality is their consumption is actually pretty high. So it's not a story we could plausibly tell, or at least not in my view, where people will somehow get more optimistic and then they'll rush out and spend more money. People are spending about as much as we should expect them to, and maybe even a little bit more. So long and short, consumption, which is far and away the largest share of our economy, okay, we're up around 70%, over 70% of the economy is consumption, almost 70% of the economy is consumption. There's no real basis for expecting that to go higher. It's about as high as we could reasonably expect it to be. Okay, next component, non-residential investment. Okay, so should we expect more investment? And here also, we hear a lot of people saying stories about, well, people are pessimistic, businesses, they don't see a lot of demand on the horizon. If you go to conservatives, they'll say, well, taxes and regulations stifling them, this and that. Well, the investment's actually not particularly low. If you compare it to the mid-90s level, we're actually somewhat higher. It's not as high as it was. We're a little bit higher just before at the business cycle peak, 2005, 2006, 2007. We're a little bit higher. We were higher in 2000. What was going on here was two things. One, we had the tech bubble. So, you could have your tech startup selling, dot whatever, and raise, hundreds of millions, even billions of dollars. So you had a lot of tech companies doing a lot of real nonsense in many cases. I mean, realistically, these companies didn't know what they were doing. So that boosted investment. The other thing that boosted investment back in 99, 2000, you remember the Y2K problem? Okay, a big surge in investment. It's very clear in the data. There's a big surge because companies had to, redo their software systems, or at least they thought they did. What they did or not, who knows? But, but in any case, they spent a lot of money. So we did have higher investment then. But we actually, you know, looking to where we sit historically, our investment today is actually, you know, it could be higher, but it's not plausible it would be hugely higher. And if you look at the data, if you look at data in manufacturing, and the reason why I say this is manufacturing is a very large share of investment. I know manufacturing is going to be a smaller share of the economy, but it's still a very large share of investment. There's still a huge amount of excess capacity in most areas of manufacturing. So that's not an environment that's terribly conducive to increasing investment. So long and short, what I'd say here is that, you know, we could expect somewhat more investment plausibly, but it's not so we have reason to expect a huge surge just because it's not terribly depressed. Okay, so if someone is telling us the story that, you know, investment's going to spring back and, you know, boost the economy and we'll get back to full employment that way, it's really not a plausible story. You could expect to see somewhat more investment, but you know, why would we expect investment in 2014 to be higher than it was as a share of GDP in 2007? You know, so maybe we'll get back to those levels. I mean, no magic to it, but I'm just saying it's really not reasonable to think it'll get much higher than that. Okay, next component, GDP, housing. This is, here's, you know, I think this is a good way of showing the bubble story. We have housing that typically has been, you know, around 4.5%, sometimes lower. Recessions, housing always falls in a recession. I'll come back to that in a second because it's one worth making in that. But it gets over 6% of GDP, about 6.5% of GDP at the peak of the bubble. Now this is, again, you know, one of the reasons why, you know, when economists say, oh, we were really surprised, and what were you surprised about? You know, what were you looking at? You didn't see this? This is, you know, this is GDP data. The government puts it out every quarter. You know, it's about the most easily available data an economist could ask for. I mean, if you're an economist, you don't know how to get this data, you're in the wrong profession. You know, so like, what did you think was going on? You know, and keep in mind, we hear a lot about demographics. Baby boomers are retiring. Okay, well, fewer baby boomers are retiring, but baby boomers are already in their 50s. They're not tending to move up into bigger homes. You know, kids are moving away, should be downsizing. The demographics, if anything, in other words, should have been pointing to lower housing. You know, baby boomers are looking to move into smaller places. They're looking to retire, downsize. Instead, we get this incredible building boom. That didn't make sense. Okay, and the outcome of the incredible building boom was incredible building bust. So two things go on. One is that because house prices have fallen, obviously there's less incentive to build. But the other thing is we had a glut of houses. I'll come back to that in a second. But you know, if you're building houses way more rapidly than, you know, than they're needed, then you suddenly have a huge glut. And that's why housing fell to the lowest level since World War II as a share of GDP. So that was predictable. The other point I wanted to make about this is just useful. Sometimes you'll often hear people say, you know, well, we haven't seen the same sort of bounce back from the downturn that we've had after other recessions. And that's true, you know, and you'll hear conservatives say, well, that's because, you know, Obama's, you know, Affordable Care Act and the regulations and the taxes and this and that. Well, a really big part of the story, bounce backs from other recessions were always led by housing. Okay, and it's a very, very simple story. How do you get the recession? We got the recessions because the Fed was worried about inflation. So to combat inflation, they raised interest rates. They want to slow the economy. That's what they're trying to do. Okay, what do interest rates slow? Well, first and foremost, they slow housing. Mortgage interest rates go up. People stop buying homes. They stop building homes. Okay, and that happens. You go back, this is the mid-70s, very steep recession. Big fall off in housing construction. 80s, same story, 81, 82 recession. Big fall off in housing construction. Okay, the good thing about that sort of recession is there's an easy recipe for it. How do you cure it? You lower interest rates. And what happens when you lower interest rates? Housing goes through the roof. Okay, so if you looked at housing growth, and you know the growth rate of construction in this period is like 40%. Okay, housing is soaring. You know, that happens after the 75 recession. We had a short recession in 70, 81, 82 recession, even the 90, 91 recession. Okay, which wasn't as steep, but that happens after every recession. It didn't happen after this one. Okay, it didn't happen for the obvious reason. We didn't get the recession because the Fed raised interest rates to stop construction. We got the recession because a housing bubble burst. Okay, so there was no reason to expect the same sort of bounce back as we saw from prior recessions. Okay, so that's always been the fuel that's led to this big boom, was that we had this big surge in housing construction, all these people employed, people go out when they get a new home, they go out and get, you know, refrigerators, all these appliances. all this feed-on effect, that was what sparked, you know, we had like 8% growth coming out of the 81, 82 recession for some quarters, not for a full year. But we had very rapid growth. Same sort of story, 74, 75. We weren't going to get this time because housing was not going to bounce back. Okay, totally predictable. You know, again, all you have to do is look at this chart and you go, why would we think it's going to bounce back? It's not. There's no way on earth it's going to. Okay, so that's one reason why this recession is qualitatively different than other recessions. The one exception I'll say to this is the 2000-2001 recession. I'm not going to go into that in detail, but that also was a bubble recession. In that case, it was the stock bubble. Okay, but different types of recessions than the ones we had previously, and that meant the recovery would be very different. Okay, next point with housing. This again, something I've used this data series that's published. I don't even have to, again, I was talking about micro data. Sometimes we get the micro data, do a computer program, and you analyze it directly. It's a published series. All you have to do is go on website, Census Bureau, and they publish vacancy data every quarter. This is vacancy rates, and again, this is one of the reasons why the bubble was easy to see. Again, you sort of go, okay, we had this run up in house prices, that run up in construction, this and that. Well, one of the things that you might ask is, well, is housing real tight? So if you found housing was real tight, then you might go, well, of course they're building a lot of housing, because housing is real tight, so they can make a lot of money building housing, relieving the shortage. Well, we had record vacancy rates before prices collapsed, which should have had a lot of people scratching their heads. Record vacancy rates, and they're building housing at record rates. What's going on? Okay, that didn't make a lot of sense. In other words, this is, when people talk about fundamentals of the market, this is pretty fundamental. How many of the units are sitting empty? Okay, so I like to look at this. People often, you could look at the Realtors Association. They have an inventory of unsold homes. So how many people have their homes on the market? That's interesting. But this is more fundamental to me. This is how many housing units are sitting empty. And you can see that's come down from the peak. It's come down a lot from the peak. But we're still way above where we've been historically. So again, the idea that we're not going to see a huge rush of new homes, we aren't going to see construction jumping back, well, again, you still have historically very high vacancy rates. Not as high as it was back in 2010, but we still have vacancy rates that are much higher than what we saw prior to the bubble years. So why would we expect there to be any sort of construction boom? Okay, so point is, we still have excess supply in housing. It will be absorbed gradually because we are still growing, our population is still growing. So this is being absorbed through time, but we still have ways to go. So what that means, what it tells me at least, is there's no reason to expect, housing's on the way back. Go back to the last chart. Housing's on the way back, but if we think of our normal level being somewhere around 4% GDP, it'll probably take us another year or two to get there. It's not like we should expect some big jump back. And the latest data is showing that, by the way, housing construction, the rate of increase is slowing. So we are going to continue, as I say, I think we'll see continued growth, but just not very rapid. Okay, next point about house prices and trend. Again, you have a lot of people talking about house prices, and it amazes me, after having been through the bubble, there's still little appreciation that you don't necessarily want high house prices. I mean, even during the bubble years, I was out there saying, well, you want high house prices, but I was kind of a minority, probably the minority of one. I mean, we should want high house prices in general. I mean, let me just put it this way. House prices are, it's sort of an obvious point if you think about it. High house prices are redistribution from people who don't own homes to people who do. Which, in general, the people who own homes are wealthier than the people who don't. Why is that good? I mean, I own a home now, so I guess I'm happy to see the price rise. But as a matter of policy, I can't see high house prices as being a good thing. But anyhow, they clearly have gotten out of line with the fundamentals at the peak of the bubble. They're about 70% above their historic level. This is a limited series. It always goes back to 87. I have longer series that I put together going back to 50. Robert Schiller, who's an economist at Yale, goes back to the 1890s, constructed his own series. And they showed the same thing, that this period of flat house prices goes way back. So here I have only going back to 87. But the series I think started going back to 50 shows house prices being pretty much flat. Just to be clear, this is adjusting for inflation. So what this means is that house prices basically moved in step with other prices. in the beginning in the late 90s, and then in particular, you know, in the last decade, house prices rose way more than inflation. Okay, so that was the nature of the bubble, that, you know, you had house prices really getting out of line with this long-term trend. Okay, they fall back and they start to rise again. This only goes through January. If I had it going more, you'd see house prices rising more. But the point I make about this is that house prices actually have risen about as much as, you know, we should expect, and I would say hope, because, you know, I don't really want to see another bubble. And I was actually very worried about this. I should have carried through the later months. But house prices had been rising very rapidly in the first half of 2013. And I was worried that we were beginning to see the reformation of bubbles in a lot of markets. I think there's still some markets, particularly on the West Coast, places like San Diego, San Francisco, where I think we might again be seeing bubbles. But it's not, it doesn't look to be a nationwide story. Okay, but in terms of, you know, should we expect further house price appreciation? I sure hope we don't see it, and the most recent data suggests that the market is cooling off and that it does seem to be settling down. So I think we're probably looking at a story going forward. House prices will do what they've done historically, pretty much rise in step with inflation. And again, just to be clear, that doesn't mean everywhere. Some places they'll rise more rapidly, some places less rapidly. Okay, here's the villain in my story, trade deficit. And my reason for saying this is a villain, you know, our problem, or at least I would put our problem, is we don't have enough demand in the economy. And the main reason for that is we have all this money going abroad. And trade deficit means this is money we have money being generated in the United States, so people are earning their wages, you know, people have money from, you know, stock, income, rental income, whatever it might be. And it's creating demand elsewhere. It's creating demand in Japan, in Canada, Mexico, China, wherever it might be. This is money that's not being spent in the United States. Creates a big gap in demand. Okay, you can see it got as high as 6% GDP, or almost 6% GDP back before the downturn. Okay, so the question is, how do you fill this gap in demand? Okay, well, in the late 90s, we filled the gap in demand with the stock bubble. Okay, so that drove consumption, drove investment. In the last decade, we filled it with the housing bubble. Okay, so how do we fill it? You know, it's a smaller trade deficit. How do we fill that today? Well, we could fill that with a big budget deficit. That will create demand, but, you know, politically that doesn't seem very viable at the moment. Okay, so then what that means is we have this big gap in demand that we have no easy way to fill. So I went through the other components of the economy. I went through consumption, I went through investment, I went through residential construction. There's not an easy way to fill this gap in demand. Okay, so I would argue we really have to place a priority on getting the trade deficit down. I'll go how we do that in a moment. But the one other point I wanted to make with this graph is we didn't always have large trade deficits. Okay, so if you look back to the mid-90s, we had trade deficits about 1%, 1.5% GDP. We began to get very large trade deficits in the late 90s. That's associated with the rise in the value of the dollar, which I'll come back to in a second. If you go back, you know, to the 70s, we didn't have trade deficits at all. Okay, we had mostly trade surpluses. We got trade deficits. This was the OPEC price increase. This was another round of OPEC price increases. We mostly had trade surpluses. We don't have to run trade deficits. Back when I was in grad school, what we were taught, and I guess I'm getting older all the time, but, you know, what we were taught then was that rich countries like the United States should run trade surpluses. We should export capital. Poor countries should be running trade deficits. They should be borrowing from us. We should be lending from rich countries to poor countries. That view seems to have gone away in economics. I'm not quite sure why, but it certainly corresponds to what's happened. We haven't been lending, we've been borrowing. We've been running large trade deficits. One of the things that, you know, I hear people say, I just want to point out, is there's really no truth to. Some people have said that we have to run trade deficits because the dollar is the reserve currency. Well, it was the reserve currency in the 60s and 70s too. We didn't run trade deficits. In other words, that's nonsense. Okay, complete nonsense. I can go more details to why that's nonsense, but it is complete nonsense. Okay, so there's no reason we have to run trade deficits. And as I say, for much of the post-war period, we didn't run trade deficits. And we only began to run large trade deficits fairly recently. We also had a high dollar there. I'll come back to that. Okay, well, this is my story, trade deficit and the dollar. And if this looks a little convoluted, I'll try to explain it. This is the value of the dollar. This is inflation-adjusted value of the dollar. So the Fed has a series where they look at the value of the dollar against the currencies of our trading partners, and they adjust it for inflation in the United States and inflation in Europe, Canada, China, wherever it might be. So this is, in principle, supposed to be how much can a dollar buy in the US versus how much it could buy in Canada, Germany, all weighted by our amount of trade with those countries. This is the non-oil trade deficit. I'm pulling out oil because oil obviously jumps up and down in price, and that's more or less independent of the value of the dollar. These tend to track each other pretty closely. So we got a large trade deficit back in the 1980s when the dollar was very high. The trade deficit fell when the dollar fell. Okay, and that was actually a conscious policy, I should point out. So back in, I think it was 86, I forget, 86 or 87, there was something known as the Plaza Accords that the United States negotiated with, I think it was France, Germany, UK, our major trading partners, Japan. They agreed that they would raise the value of their currencies against the dollar, and it did exactly what we wanted. We got the trade deficit down. So we got trade deficit down as low as 1% GDP. Okay, I'm sorry, this chart, 1% GDP. We kept a relatively low trade deficit till the late 90s, when the dollar again rose a lot in value. That shows up as a fall here. Okay, rose a lot in value, and the trade deficit then exploded, and we eventually got this trade deficit peaking or non-oil trade deficit about 3.5% of GDP. Okay, well, let's follow very directly. What happened in the late 90s to cause the dollar to rise so much with the East Asian financial crisis, and we created the conditions of the bailout that was done through the International Monetary Fund, but that was basically engineered by Treasury. And the conditions were very onerous, and the outcome of that was that countries felt they didn't want to be in that same position. They felt they had to accumulate large amounts of dollars, which meant run trade surpluses with the United States, which is exactly what happened. Okay, so they kept down the value of their currencies against the dollar. They ran large trade surpluses, which meant we were running large trade deficits. Okay, to my view, that was very bad policy, but the key point, or my key takeaway from this is there's a simple, at least simple to talk about, way to fix the problem. We get the dollar down. Okay, so we got a high trade deficit because we had a very high dollar. We want a lower trade deficit, you get the dollar down. And that's basically, a matter of negotiation, just as it was back in the late 80s. We sat down with our trading partners and we negotiated a story where they increased the value of their currency against the dollar. Basically, that's a story we have to do today. People often talk about China. That's probably the most important actor there, but it's not just China. It would be with Korea. It would be with our other trading partners as well. So the key to getting our trade deficit down doesn't have to be balanced, but getting our trade deficit closer to zero is to get down the value of the dollar against other major currencies. Again, it's not a question. People sometimes talk about us beating up China. We got to be tough on them, this and that. No, you sit down and negotiate. China's not Guatemala, Honduras. It's not. We're going to go to them. We're going to tell them they're going to do X, Y, and Z. We're going to have to negotiate, and that can be done. Okay, this is just the point I was making before about getting back to full employment, why it's so important. This was an analysis that this is in the book Jarrett and I wrote about the impact of lower unemployment on wage growth. And what we're showing here, this is in effect, the way to think about this is if we sustained a 1 percentage point lower rate of unemployment, imagine we could snap our fingers, the unemployment rate's 1 percentage point lower, not just for a year, but for the next decade. Okay, what would that do for wages at different points of the income distribution? And we have broken out for men and women. The implication of this is that wages for men at the 20th percentile, this means a worker that earns more than 20% of workers less than 80%, so towards the bottom end of the wage distribution. For men, their wages would be 12%, 12.4% higher. For women, 8.9% higher. That's a big deal. Okay, at the 50th percentile worker right in the middle, it's still almost 4 percentage points, 3.8 for men, 4.2 for women. Okay, so it's a very big deal. When you get to the top end, it's not very much. Okay, so for some of the 90th percentile, it's not very much. These also weren't statistically significant, so we included them to be complete, but relatively small effect. So our point about doing this is that there's a very big impact on distribution, income distribution, if we could sustain a lower rate of unemployment. So just getting back to the point I was making at the start, it's very important we try to get the unemployment rate down. It means a great deal. If we're concerned about inequality, we're concerned about the well-being of workers towards the bottom end. This is a very, very important way to get them more money. Okay, I should also point out, this is just showing hourly wages. So this is saying what happens to your hourly wage. When you have a lower rate of unemployment, you also increase work hours. the number of hours people work, and that's strongest at the bottom as well. So it's another way in which the incomes of people at the bottom will be affected by having a lower rate of unemployment. So again, that's why we think it should be a very important priority. Okay, just repeating that, this is what I showed you at the beginning. Again, long way to go. 6.5% should not make any of us happy. Just to conclude, my two takeaways, we're not going to get back to full employment unless we get the trade deficit down. Again, we could have large budget deficits. I have friends who want to have big stimulus packages. I go, great, I'd love to see it. I don't think it's going to happen. So if we can get Congress to sign on to a big stimulus package, $300 billion, $400 billion a year in infrastructure spending, aid to state and local governments, would be wonderful. I don't think it'll happen. So that's why I focused, let's get the trade deficit down. And the last point, again, I think we really have to keep that front and center. It's not just getting people to work, but it means we want to see low-end workers, and again, I'm a big fan of raising minimum wage. We should try to do that. But we also need to support that with a strong labor market. That means getting unemployment again. So I'll stop with that.
We have some time for questions. I get to ask the first one though, because I'm curious. Who loses if the U.S. has a weaker dollar? Who's going to fight against that? Why? If this would be such a wonderful bullet against this problem? There must be somebody that's against it.
The bad guys.
Yeah, I figured.
Okay, no, it's a really good, really important question. There are actually a lot of people who benefit from having a hideout. So if you think about this for a moment, we're importing all these goods from abroad. Well, I'll pick everyone's favorite villain here, Walmart. Yeah. Walmart has put a great deal of effort into establishing low-cost supply chains. They're getting goods from China, from Bangladesh, the cheapest sources in the world. They're not anxious to see all those goods go up in price by 20%. Okay, so I'm picking on Walmart because they're the biggest, obviously, but other retailers are in that same boat. Same thing on the manufacturing side. That General Electric, any big company, almost all of them have at least some of their products. In many cases, many of their products or parts are coming from overseas. So again, they're not anxious to see the price of the goods that they are bringing in. So it's not that we have Chinese companies, Japanese companies. We have that to some extent, but in many cases, it's U.S. companies who certainly have a direct line to the president, direct line to members of Congress. They are anxious to see it. The other part, when I was saying we would negotiate, okay, so we're sitting down, we have the leaders of China or the other countries at the table. So we're going to negotiate. We're going to say, here's what we want. Well, actually, Timothy Geithner said this. I always envision it, but I actually heard him say it, and so I don't have to speculate about it. He said, we always raise the currency issue when we talk to China. So of course we have a lot of issues. we just don't need everything. So okay, so Microsoft's upset because people in China make copies of their software and they don't pay them. Pfizer's upset because they're making drugs that they want to sell at real high prices, and in China they're making unauthorized copies. They don't get money from that. Goldman Sachs wants to have more access to China's financial markets, because they can make a lot of money that way. So there's a whole list of things like that when we sit down with China, they're all on that list. And somewhere on that list is also the currency. Well, obviously we can't sit down with China's leadership. This isn't a little country. We can't sit down with them and say, hey, we want you to do X, Y, and Z. They're going to look it over and go, we'll give you a little of this, we'll give you a little of that. What are you going to give us? So if we're to sit down and do what I would want, he made me president, it's going, okay, we want you to raise the value of your currency. There's other things we want too, but this is what we want. We'll give you something for it, and then we'll talk about the other things. But that's clearly not what happens. Okay, so it's just not the priority.
I would settle for you being Treasury Secretary. In the back, in the far back.
So what would the U.S. offer in negotiations in exchange for China and Korea raising down with their currency?
Well, I would say part of that story would certainly be, we don't care about Microsoft, we don't care about Pfizer, so part of it would just be reversing, what I just said. They're going to have their list of things they want from us. So they'll want more access to our market in different areas. So they'll have their list of things. So as I say, some of it is stop pressuring them on areas where they have their own interest. Obviously, they have their financial companies who don't want to compete with Goldman Sachs. Maybe they should, but I don't care. It's not a priority for me. So we would not press them in some areas that we had been pressing them, And again, I'm sure they'll have a list of things where they feel they're not being treated right, or whatever they have interest, and give them some ground on that.
David?
If you were attempting to communicate to the general public here in North Carolina, what would be the 3 or 4 things that you would say that justify why the upper 10% should start worrying about the income disparity of all the rest?
Well, I think that it's a story that, in general, people in the United States have cared about the sort of society that they live in. Now, I realize for some
that's bullshit. Really? That's
Yeah.
not happening in this state.
They say they do. In terms of is it going to make them better off if they, if we do things to improve the plight of the bottom 90%? I can't say that, because a lot of them, realistically, they're not committed to this country. A lot of them have vacation homes in, Bermuda or wherever it might be. And if things got really bad, if people were very unhappy, there were high crime here, they just go, well, that's fine, I'll just go to the vacation home. So, I mean, that's not really true some of the 90%. If you're talking about the 1%, I mean, people at the 90%
Let's
are
talk about
rich.
the 90% because that's where a lot of people are.
Okay, well, 90%, I think in that case, someone in the 90th percent, obviously they're 90th percentile, they're relatively comfortable, but they're concerned about their kids. There's certainly no guarantee that their kids are going to have, 90% is probably almost certainly someone who graduated college, likely a professional. No guarantee that their kids will have the same success. They might, but they might not. So I would think you'd want to be able to say, don't you want to make sure that your kids, maybe you're a successful lawyer or something, but your kids maybe for whatever reason don't follow that path. They don't do well in school, or they're not interested, whatever it might be. Don't you want to make sure that they could have a decent standard of living? I think that would be, the main thing. And and someone at the 90th percentile can't sort of buy themselves out of all of the social problems. They can't, if you're living in a high crime area, they can't, get security guards, and so they can't evade those problems. So if you want to be able to know you and your children, your family can live safely, have decent schools, then you have to talk about paying for them. You have to talk about having an economy where most people have a decent standard of living, not just a small minority. So I think these are things you can truthfully say to people at the 95th percentile. You get to the 99th percentile, they can say, I don't care. I got enough money. That doesn't concern me, doesn't interest me. But people who are a little lower down, again, obviously by definition, they're relatively well off, but they aren't so separated. And that's actually something, by the way, we've recently seen, because we've gotten better data on this, that it really has been a story of the 1%. So. We used to talk, and there is some improvement of the 90% relative to the 50th percent, 10th%, but not very much. Most of the story is going to the 1%, which, is 2 separate things. One is that we are talking about a very small number of people. The other thing, oftentimes people talk about the 90% saying, well, the story there is you get a college education. Well, people with college degrees have not particularly been gainers in the last decade. So they've gotten very little benefit. It's really just been a very small group of people. So saying, well, you just need to get an education, well, that's good. People have gotten educations. We've had a growth in people getting college degrees, but they're still not benefiting.
Mary B.
Mary B. McMillan with the North Carolina AFL-CIO. Could you talk a little bit about the effect of declining unionization rates on wages and on our whole economy?
Yeah, declining unionization rates, I think, are a big part of the story of wage inequality over the last 3 decades. So, most people are probably familiar with the basic story. The unionization rates, primarily private sector story, that it'd been around 20% back in 1980. Today it's less than 7%. So we've really seen plummeting unionization rates. And what that's meant is workers have been much less able to share in the economic growth. So, we focused on getting the unemployment rate down, which is one way of improving workers' bargaining power. The other is if they're in a position to organize, if they're unionized, then they're in a position to get their share of the gains. And unfortunately, many fewer workers are in a position to do that. One of my points in emphasizing the decline of private sector, If you look at the public sector, there's little change. I mean, it's down a little bit. You know, I don't have the exact number, but if you go back to 1980, it's like 36, 37%. It's 34, 35 today. I think that's an interesting contrast because the point, or at least my takeaway from that, is that those workers, you know, it's not as though we, you know, were born, you're a public sector worker, you're a private sector worker. Presumably, you know, on the whole, they're not qualitatively different people, and oftentimes they're in the same family. You know, that people in the public sector seem to still want to unionize. In the private sector, it's not, they made a choice not to unionize, it's become much, much more difficult to unionize in the private sector. So, you know, my view on that is that if you didn't get fired, if you didn't risk getting fired for organizing, we'd see much higher unionization rates in the private sector. It wasn't just that workers decided they didn't want unions.
Dick, did you have a question?
Dick Nash. Currently on the horizon is another very big trade agreement in the nature of NAFTA. What is your feeling about that?
Yeah, the Trans-Pacific Partnership. There also is a deal with Europe, the Transatlantic Trade and Investment Pact. You know, I think these are really bad deals. The basic story, they're really being misrepresented because they're not about trade. At this point, our trade barriers with these countries are, with few exceptions, already very low. So the idea that we're sitting down and putting all this effort to, you know, change a 1% tariff to 0, you know, it doesn't make sense. You wouldn't do it. So that's not what they're about. They're about putting in place a regulatory structure that I think for the most part is not going to be one we're going to like. It's going to be very pro-corporate. And what it does is, you know, really what NAFTA did, but just on a larger scale, it moves decision-making away from, say, local governments, state governments, federal governments, and puts them in these international bodies that, you know, almost no democratic input into. And I just can't see a rationale for it. And in fact, you know, they talk about gains from it. There actually might be direct economic losses because a very big part of these deals is the drug companies are very big actors here. They want to charge higher drug prices throughout, you know, our trading partners, and a lot of it might feed back on the United States. That's going to slow economic growth because that's pulling money out of the economy, giving it to the drug companies. It's money that might otherwise be spent here on other products. So I see this as a huge negative. I just can't see a story as to why the public should support this. And it's the way they're going about this is especially pernicious. So what you have is a treaty that's being negotiated in secret. We know what we know because they're leaked documents that WikiLeaks has made public. That's why we know anything at all about it. And their intention is to have fast-track authority. So they're going to drop it on Congress and give it 30 days or 60 days. So, you know, so they're just going to go, okay, here it is. You got, you know, 30 days, all or nothing, you know, and, you know, all the corporate lobbyists are going to be jumping on these people saying, if you don't vote for it, you're not getting a penny. We're going to give everything to your opponent. You got to vote for it. You can count on the news media, you know, Washington Post and NPR, you know, oh, unless you're a reactionary Neanderthal, you're going to be supporting this. You know, there'll be a huge amount of pressure, and that's their way of getting it through. There'll be no chance to really consider it, and, you know, again, it's all or nothing. So there might be some really bad provisions that they go, oh yeah, those are bad, but you still have to go for the rest. So it's a really pernicious pact. There's not an argument for it.
Thank you. A couple more questions right here in the middle.
Yeah, hi, I'm Dick Cheney from the Durham People's Alliance. And first of all, thank you for being such an active and articulate spokesman for progressive causes over the years. I see you on the tube all the time. And you know, the infrastructure spending seems to be a great way to jumpstart the economy. Yet that's stuck in Washington. And I'm surprised that with all of the companies that could be involved, with the unions, with the mayors and all of that, do you see any possibility of some harmonic convergence of all those forces that would finally free that up?
You know, unfortunately, I can't say I do. I mean, you've gotten to this dynamic in Washington where the Republicans are intent on saying no to anything that, you know, the Democrats put forward. You know, so if they go, hey, it's a sunny day out there, you know, the Republicans go, I don't think it's so sunny, you know. And it really has gotten to that point. I'm generally more aligned with the Democrats, but I'm not saying they're just out of partisan. You know, I think I know Republicans will say that too. I mean, it just, you know, obviously the Democrats have been partisan too. You know, so but I think it really has been extreme. So I have a very hard time seeing that happening in Washington. Now, one possibility is that I think at state levels, you can see some support for this. So in many states, there has been bipartisan support for increased infrastructure spending. And my latest sort of dream on this is, you know, I've been thinking, Governor Parrish from Texas has been out touting how Texas is a great miracle. Well, one of the big things that Texas has been growing because it was their oil and gas boom. So I was thinking, wow, what a great idea. Why don't we have, states that don't have any oil or gas? I'm from the Midwest, so, Michigan, where I went to grad school. Suppose they put a nice big tax on energy, on gas and, home heating oil, and they rebated it to people through their income tax, most of it, so people who earn 20, 30, 40, 50,000 a year, they'd be made pretty much whole. I mean, if you drove all the time, you'd still end up a loser. But basically, if you're the average person making 20,000, 30,000, you're getting as much back from lower income taxes as what you're paying out in higher oil taxes, higher gas taxes. And then you take a portion of that and use it to pay for making homes more energy efficient, installing solar paneling, doing other things to reduce energy consumption. Public transit too, that'd be another thing you could do with it. So you in effect, you're taxing Texas to make Michigan more energy efficient. So that's my latest plan.
We won't hold our breath. In the very back.
What impact do you think raising the minimum wage would really have on the unemployment rate? Would businesses shed jobs?
Yeah, this is very interesting, very important question. Very, a lot of research on it. Most of the research actually isn't that far apart. So you often have it presented that, there will be job loss, there won't be job loss. My view is there likely will be some job loss, but likely very little job loss. And I have, I know people work for, members of Congress go, no, it's got to be zero. Well, look, someone somewhere is going to lay off a worker because of a higher minimum wage. The question is the numbers. And I think most of the research points that, if we talk about raising the minimum wage 20 or 30%, maybe we'll reduce employment of teens by 1 or 2%. Now, that sounds bad. You're going to make these people be out of work. Well, you think about it for a moment. Most of these jobs tend to be high turnover jobs. In other words, we're not, people aren't in a job for 20 years. And most of the time what we're talking about isn't someone literally laying off workers. It means that, when business expands, they might be slower to hire another worker. And when someone leaves, they might not replace them. So what it likely means, the story that we're saying from the standpoint of these low-wage workers is that it might be the case when you leave a job, whether you were laid off, fired, or you just decided to quit, whatever, it might be a little longer before you find another job. When you do find that job, you're going to be earning 20 or 30% more. That to me looks like a pretty good trade-off. So I feel pretty comfortable. The numbers that are being thrown out of Washington, $10 an hour, I think we could do with a minimal impact on employment. Some places, some states have talked about higher minimum wages. Obviously, that will vary by state, what the living standards are there. San Francisco, I forget exactly what their wages are. I think it's over 10 an hour already. No impact, a lot of people have studied that, no measurable impact on employment. You can do it too high, though. I know people have talked about $15 an hour. You could envision some large employers being able to do that. I certainly would advocate, certainly not quickly, moving to minimum wage of $15 an hour. I mean, I was looking at historically, we first created minimum wage laws, federal minimum wage laws in '38, and from '38 until '68, minimum wage didn't just keep pace with the cost of living; it kept pace with productivity growth. If we had continued that to the present, the '68 minimum wage would be $17 an hour. So you can, in principle, do that, but I wouldn't say you could do that quickly, and you certainly couldn't do that without other changes to the economy. So when I hear people say, talk about higher minimum wages, and I'm not talking about trying to get a negotiated wage. If workers can negotiate a $15 an hour minimum wage with Walmart, fantastic. But in terms of passing a law saying everyone has to pay $15 an hour, I think that'd be a problem.
I had heard that if you raise the minimum wage, it's going to automatically up the higher wage, because the minimum wage goes up, the wage rates above that will rise. Is there anything to that?
Yeah, there's been a lot of research on that. Congressional Budget Office recently did an analysis, and they basically concurred with that research. So the numbers, if you took the $10 an hour proposal that President Obama's put on the table, I think it was something like 18 million would be directly affected. In other words, they're between the current minimum wage, $7.25 an hour, and $10.10 an hour. So there's 17, 18 million that would be directly affected. And then there'd be another 8 million or so that they estimate would see their wages bump up. So people who might currently be earning, $10.50 an hour, $11.50 an hour, they'll see some bump up. So it stands to reason, if you made a point of, paying this worker a bit above, the other workers, because they've been there a few years or something, they've been promoted. We want to keep those gradations so that they'll continue to get bumped up if the minimum wage were to rise.
And I've got Alan Fryer is going to ask the final question.
Aside from currency, how else do you get the trade deficit down? Or how else would you?
I think currency is far and away the most important thing. I mean, people have talked about, removing trade barriers. We could try to do that. So invariably there are some barriers, but that's really kind of nickel and dime. Also, people have talked about industrial policy. That's great, but that's kind of speculative and certainly long term. So even if people I think sometimes talk about industrial policy, it's a mantra. You just go industrial policy. And as a reality, there are things we can and have done. And they've often been successful. Sometimes they're not, but they've often been successful. I think there are useful areas. Promoting solar technologies. I mean, these things we are doing, and with some success, we could do them more. But none of them provides any sort of slam dunk, and at best, it's a more long-term proposition.
To find Dean online, the Center for Economic and Policy Research, CEPR.net. Is that correct? CEPR.net, or the Huffington Post, where he is a prolific commentator and contributor and all over the television and radio. Join me again in thanking him for an excellent